Hey, what's going on, guys? My name is Richard Moglen and welcome to another stock market video. Today, what I want to talk about is the technicals and fundamentals of 14 different stocks that I think you should consider for your long-term portfolio. And just to be clear, we are currently in a stock market correction, so this is not the time to be going out and buying stocks. Instead, you should be waiting for that fall through day and other signals that indicate that the uptrend has resumed. But the good news is that there will be another bull market, and these are the perfect additions for your account to maximize your returns. So in this sponsored video, we're going to be talking about the 14 stocks on the IBD long-term leaders list. And these are all stocks that have had stable earnings growth and excellent price performance over the years. So currently there are, as I said, 14 stocks on this leadership list, and we're going to be going into MarketSmith and checking each out individually and looking both at their fundamentals and technicals to help you find the perfect buy point. So starting with Adobe, this is a company whose products I use every single day. I make my videos using Adobe Premiere and also my thumbnails using Photoshop. So I think this is a great company and their fundamentals and technicals reflect that. So getting some perspective, we'll check out the monthly chart, and you can see that just over the years, this stock has done unbelievably well. And you can see that relative strength line is increasing at this moment, which is exactly what you want to see during a correction, because that indicates that this stock is doing better than the overall market. And going back to the weekly chart, we can check out the fundamentals of this stock. And you can see that just for the past 8 quarters or so, we've had great EPS percent change and also sales percent change. So that's exactly what you want to see from a company, because those numbers translate into more and more institutions becoming interested and taking up positions. And we can actually check out how many funds are currently owning the stock. And you can see that we've had a steady increase in that department, which is once again exactly what you want to see. So this is a perfect stock to consider for your long-term portfolio once this correction is over. And now let's go ahead and talk about the next stock, which is Amed. So Amed is the next stock on our list, and if you're not familiar, it essentially provides home nursing services to individuals. And once again, it's had excellent both earnings, sales, and price growth over the years. And checking out the monthly chart, you can see that just unbelievable growth really since 2012. And once again, that RS line is increasing, which means it's doing better than the overall market right now during the correction. And going back to the weekly charts, here's kind of the things that I key on. So once again, we've got good earnings percent change growth, sales percentage change growth as well. Let's check out the return on equity. You can see that's at 26%, which is a lot higher than kind of the 17% baseline that I look for. So that's great. And you can see that the earnings estimates are up 14% for 2020 and up 20% for 2021. So these are exactly the growth numbers that I want to see. And you can see that the ratings up here from IBD are stellar as well. So excellent company. And moving on, we've got Alibaba, which is the global online retailer based in China. So this is one of the newer stocks on this list, but still it's got that great track record and got that ability to provide growth over time. So looking at the earnings numbers, you can see big increases in that department as well. Most notably, last quarter, you had a 76% sales change, which is fantastic. And let's go to the monthly, and you can see that even though it is a newer company, it had dramatic growth in 2016 and 2017, and seems like it's consolidating right now and potentially ready for another leg up. So going back to the weekly chart, let's check out the fundamentals. So the return on equity is 21%, which is fantastic. You've got good EPS growth rate over here. EPS rating is a 99, Group RS rating is a 99, SMR rating is an A, that's perfect. And it's got an overall composite rating of 99. So great ratings from IBD, except really for this accumulation distribution rating right now. But you can see that the estimates for 2020 and 2021, even though they're up, the estimates have been dropped down. However, they're still very good, 25% and 22%. You can also take a look at a couple of the other stocks in the same group. So the top RS in the group is VIPS, which has also been a very good company. So that pretty much is it for Alibaba. Very good company. You can see a basically long consolidation period from really March 18th all the way till now. So once this correction is over, this could be a big winner during the next bull market. So next up, we've got CPRT, which conducts salvage vehicle auctions for insurance companies. And once again, going to the monthly chart, the growth is just obvious there. And you can see that more importantly, even than the price growth, you can see that the relative strength has been hitting new all-time highs recently, which is exactly what you want to see. This means that it's been outperforming the S&P 500. So you can see that the big drop recently, as with a lot of stocks, but overall it's been doing fantastic since its IPO in 1994. So going back to the weekly chart, you can see that the return on equity is 32%. That's fantastic. You've got great earnings growth here, great sales growth, really good ratings from IBD as well. And you can see that the earnings estimates are up for 2020 and also 2021. However, along with Alibaba, you can see that the estimates are down, as probably a lot of stock earnings estimates will be because of this coronavirus and its effects on the economy. But overall, still a very good company. And currently it's dropping pretty hard, and the RS line is dropping a little bit. So you might want to wait for that RS line to drop back up and hit all-time highs again before you choose to invest in this company. But overall, a good buy. And you can see that after this buy point area, it really exploded all the way in 2019. So when there is a bull market, this stock has the capability to do very, very well. So next up on the long-term leaders list, we've got Dollar General, which is also just a fantastic company. So overall, looking at the monthly chart, you can see basically a straight line up since its IPO in 2009, which is exactly what you want to see. And going back to the weekly chart, you can see that recently its relative strength has been holding up very, very well. And it's actually hitting all-time highs, which is rare in this type of market. Looking at its return on equity, you've got 26%, which is fantastic. EPS ratings an 86, Group RS is a 56, SM rating is an A, accumulation distribution rating is a D-, which isn't that great, but overall it's still a very good company. You've got that earnings growth in there, very steady, sales growth as well, very steady. And you can see that the earnings expectations for this year is 6.73, and next year the estimates are up 11%, and for 2022 they're also up 11%. And also just taking a look at the funds real quick, you can see that we've got an increasing number, which is exactly what you want to see. So that is pretty much it for Dollar General. And next up, we've got Domino's. So if somehow you're not familiar, this basically is a pizza business, and it's actually been one of the top performers of the last decade. So going to a monthly, you can just see this amazing growth. And once again, I want to kind of point out the fantastic RS line. So it's actually in all-time highs right now, and it has just been steadily increasing along with the price, suggesting that it's been outperforming the S&P 500. So a great long-term hold. And let's take a look now at the fundamentals. So first of all, we've got the return equity that's not available. However, you have very good earnings growth and sales growth. Pretty impressive, actually, plus 59% last quarter and plus 26% in terms of sales. And you can see that the RS line is near all-time highs, even though we are in a correction at this time. That's exactly what you want to see. If you only focus on stocks right now that are hitting all-time highs and bought them once this correction comes to an end, you will do very, very well. So Domino fits that bill, and this long-term growth is the reason why it's on this IBD list. And taking a look at its ratings, EPS ratings in 94, Group RS is only a 32, and overall you don't have the best IBD ratings, but the price and earnings growth speaks for itself. You've got earnings estimates for 2020 plus 14%, but the estimates are down. And for 2021, you've got Earnings growth expectations up 13%, but once again, the revisions are down. Next up, we've got EPAM, which is a provider of outsourced IT and life cycle software development services. And overall, once again, as with all these stocks, it's basically been a straight line upwards since its IPO. And once again, that RS line is increasing, and going to the weekly, we can see that even during this correction, even though it's been hit pretty hard, it is outperforming the market at this time. And taking a look at its return on equity, you've got 22%, which is fantastic, and its IBD ratings are very, very good. So overall, you've got an EPS rating of 96, a group RS rating of 57, SMR rating A, accumulation distribution D-, but the overall composite rating is a 96. So very, very good company, and you can see steady earnings growth and sales growth for the past few quarters. And if you're looking for stocks to add to your long-term portfolio, if they look like this, they're going to be a pretty good bet going forward. And once again, the estimates for 2020 are up 16% and 2021 up 22% on top of that. However, you can see that as with many of these stocks, the revisions are downwards. So next up, we've got FISV, which provides integrated information and electronic commerce system services worldwide. And you can see from here, and if we go to a monthly chart, you can see even clearer that as with all these stocks, it's a straight line upward. And once again, its RS line is right near all-time highs, which is exactly what we want to see. And taking a look at the fundamentals, you've got return on equity of only 13%. I would like to see this higher, but it's still pretty decent. And the EPS rating is an 88, group RS is a 75, SMR rating is a B, accumulation distribution rating is a D-. A lot of stocks right now are going to have poor accumulation distribution ratings, and that's why I think in these times during a correction, what's most important really is that RS line and that RS rating. And currently the RS rating is a 75, which means the overall year rating is a 75, but the short term is probably much, much better. So IBD has both a 3-month, 6-month, and longer term RS rating. And because this RS line isn't really going anywhere, the 3-month is probably much better than this overall 75. But looking at the earnings and sales, you can see plus 21%, and not the greatest sales growth here, but still overall pretty decent growth from this company. And the estimates are up 12% for 2020, and 2021, it's up 18%. And once again, the revisions are down. So next up, we've got MasterCard, which, if you don't know, provides global payment solutions and creates the technology behind a lot of credit and debit cards. So overall, once again, if we go to monthly chart, it's been a very good performer since its IPO in 2006. And recently, you can see it has taken a hit with the overall market, and its RS line isn't doing too great, although you can see right here, it's basically kind of forming a base right now. And once the overall market turns around, then we can see what it truly has in store for us. And overall, its earnings and sales growth is very, very good, really off the charts, basically plus 30% at least the past 4 quarters, which is fantastic. Sales growth as well, increasing as well. And you can see that the return on equity is 141%. That's fantastic. And EPS rating is a 96, group RS is a 77, SMR rating is an A, accumulation distribution an E, and the overall composite rating is a 97. And you can see that the earnings expectation for this year is up 13%, and for 2021, it's up 20% with the revisions down as well. I feel like I'm going to say that for pretty much every stock that we're looking at right now. But overall, very, very good company. And next up, we've got MASI, or Masimo Corp, which develops patient monitoring products, which include a monitor, circuit board, consumables, and reusables. And looking at its monthly chart, you can see that it actually based for a while after its IPO, but then since 2014, it's really taken off. And a lot of the stocks that I see on Twitter and in my comment section, a fair number of them kind of look like the initial period of Masimo Corp, where the stock may be going up in the near term, but it hasn't done that much. And this is where really the green line concept comes in, because if you drew a green line from the previous all-time high, you wouldn't even be looking at the stock until it's breaking out of this long-term base here and in this growth period instead of this kind of long-term consolidation period. But right now it's doing very, very well, even though it's been hit pretty hard by the overall market and the economic effects of the coronavirus. So looking at the weekly chart, let's go ahead and take a look at the fundamentals. The return on equity is 17%, exactly at kind of the threshold that I look for. The EPS rating is a 68. The group RS is an 81. SMR rating is an A. And composite rating is an overall 95. So last quarter, it did have a negative EPS change, but the sales were still up. And for 2020, the estimate is up 11%, and the revisions are actually up. And for 2021, you've got estimates up 13%, and the revisions are down for that. So that is Masimo. And let's move on to MSCI, which provides investment decision support tools for institutions investing in equities. And looking at the chart, you can see it's been doing very, very well. As with all the stocks, it's been doing very well for a long time. Since 2013, it's been on a very big tear. And taking a look at the fundamentals, you've got return on equity that isn't available, but you've got really good earnings and sales numbers. That EPS rating is a 98, group RS is a 75, SMR rating is an A, accumulation distribution is a D-, as with a lot of stocks at this time, and that overall composite rating is 98. So it's better than 98% of other stocks. Its estimates for earnings are up 14% this year, and for 2021 up 15%, but the revisions are down. And as we already mentioned, the earnings growth is very, very steady and very, very good as well. And the sales growth is also there. So that's pretty much MSCI. And next up, we've got MSFT, which is Microsoft, which if you somehow don't know, it creates operating systems and business software. And it was one of the best stocks of 2019, the best long-term holds, and was really doing very well until the correction hit. And going to the monthly chart, you can see that in the big run-up and the dot-com crash, it was hit very, very hard. It actually took quite a while to break through that previous all-time high. But you can see that since 2015 and 2016 consolidation, it's been on a very large increase, and that RS line is also going into all-time highs. Going to the weekly chart, let's take a look at the fundamentals. Return on equity, fantastic, 40%. EPS rating 96, group RS rating 98. So a very good group overall, which is key to see. You want to be looking at the best stocks in the best groups, because if a overall group is doing well, that tells you something about how that group is performing and that industry is doing compared to the overall market. And earnings growth is very steady, sales growth very steady as well. And you've got a 19% earnings estimate increase for 2020 and 11% for 2021. So very good company and a good idea to look at this one after this correction ends. So next up, we've got ServiceNow, which provides cloud-based IT software for workflow optimization and data consolidation, which is super important in today's day and age. So overall, looking at the monthly chart, it's been doing fantastic since its IPO in 2012. And it has taken a big hit with the overall market right now. And going to the weekly chart, we can see how its RS line is doing recently. It's hanging in there right near all-time highs, and isn't taking a huge hit relative to the overall market. So still a good idea once we come out of that correction to take a look at how ServiceNow is doing. And its return on equity is also 40%, fantastic. The IBD ratings are very, very good. And take a look at these earnings and sales growth. This is exactly what I look for a potential investment. You've got plus 81% last quarter, plus 123% 1 quarter ago. So this is incredible growth. And the sales growth is also backing up that earnings growth, which is always good to see. For 2020, the estimates are up 28%. For 2021, up 30%. And the revisions are up as well. And just looking at the chart where we've got all these earnings numbers, you can see that it's just constantly producing excellent earnings, which is what institutions love to see. So last on the long-term leaders list, we've got Thermo Fisher Scientific, which produces mass spectrometers and other instruments just like that. So overall, it's been a very good long-term hold, and it's been increasing steadily really for decades. And taking a look at its fundamentals, you can see that the return on equity is 17%, right at that threshold. Good EPS rating at 86. Group RS rating is a 79. SMR rating is an A. Accumulation distribution is a B. And its overall composite score is a 97. And once again, along with all of these, really, it's got very steady earnings growth and sales growth, which is exactly what institutions like to acquire in terms of these type of companies. And the estimates for 2020 are up 10%, and for 2021 up 11%. And just to round it off, you can see that the funds are increasing and have been steadily doing so over the past couple quarters. And really it shines in terms of its recent relative strength. You can see a big jump in terms of that RS line. And that's really what I'm keying in on at this time, because these type of companies that are doing well in a bad market are going to do very, very well during the next bull market. So that's it for the video. Thanks so much for watching. Please remember to leave a like down below if you enjoyed this video, and subscribe for more videos just like this one. Thanks so much for watching, and I'll see you guys in future videos.